2 months into the new year, and even while we've been reporting surprisingly resilient home buying activity this new year, it's not nearly enough to change our view that home prices will be flat to slightly down for the year nationally. As pricing data for 2023 becomes more mature, we can now start to see how quickly last year's prices will catch up to this year's. We'll look at that today. Inventory is falling still, so the supply side of the supply demand equation helps put a floor on prices. There are just so few homes for sale that this market will likely remain tight all year. Rising mortgage rates don't appear to be adding much to inventory, but they are keeping prices held lower. This is an affordability issue for sure. Every week, of course, Altos Research tracks every home for sale in the country. We analyze all the pricing, the supply and demand, and all the changes in that data, and we make it available to you before you see it in the traditional channels. The data we cover here in these videos is national, but is available from Altos for every zip code in the US. If you need to communicate with buyers and sellers right now, there's a link in the description below to join us. I'm Mike Simonsen. I'm the founder of Altos Research, and here's what we know at the end of February 2023. The trend in home prices is probably the most notable thing in the data right now. At $420,000 or so, the home prices are still up nationally over last year at this time. All that margin was gained in March, April, May of last year. There are markets where home prices are lower than last year at this time, and there are a few markets like San Francisco where home prices are lower than 2 years ago. But in general, across the country, home prices are still up about 6% higher than last year. At that time, prices were still sprinting higher each week as buyers fought to get in before mortgage rates jumped. So now, each week, our yearly price gain is eroding. The median price of single-family homes right now in the U.S. is $420,320. That's up a tiny fraction from last week. Normally, this time of year, home prices are bumping up rapidly each week with new inventory and of course, more buyer demand in the spring. You can see the dark red line here is just not sprinting higher. At the far right end of the chart, you can see how low the slope of appreciation is. It seems like we're kind of at a price ceiling. Buyers are buying some homes, but we can really see the mortgage rate affordability problem keep that lid on where prices can go. Prices will tick up through June, but at a much slower pace than recent years. And so you can see at this pace, we will peak significantly under the price peak of last year in June. The median price of the new listings this week is at $399,000. That's already the same level as last year at this time. New sellers know where the demand is, and in aggregate, they price very close to their eventual sales price. So year over year, 0% year-over-year gains implies 0% year-over-year sales prices in the future. This tells us a ton for the year. Next week might be negative for the first time on the new prices, the price of the new listings, because last year prices were spiking up so quickly. So that's the light colored line here. It's notable, too, that the median price of the pendings is $370,000, which is also unchanged from last year at this time. The pendings are the homes that are in contract but not yet closed. Last year's pending sales price is a little understated probably because we had overbidding happening. So when these pendings close, the sales price will be at or below last year's sales price. So the homes that are pending contract now will close in March or April. So be ready for the headlines in the next few months. May, June, home sales prices will be down year over year. And we'll see it. We'll start seeing it in a few months in the headlines. Sales prices are a lagging indicator of the market, though. A home gets listed today, it gets an offer in March, it closes in April or May, and then you have that data in June. So while we can see that the sales price headlines will start reporting flat or down in the next few months, I prefer to focus on what's happening in the market right now. And the big thing to note right now is that available inventory of homes for sale declined by another 1.5% this week to just under 430,000 homes, single family homes. There's no indication anywhere in the data that we have a flood of new inventory coming. You can hear plenty of hypotheses about where future inventory might come from, but none of that is in the data now, in the market now. So while prices are down, there is no supply side catalyst for like a big bubble burst correction happening. There are 60,000 fewer homes on the market now, single family homes on the market now than there were even at over New Year's, the New Year's weekend just 2 months ago. So coming out of the fourth quarter, we expected a continuation of that market freeze, which would mean rising inventory levels in the first quarter. Our forecasting model at that moment expected that right by now we'd have over 500,000 single family homes, and there's only 429,000. So each week we've been surprising to the downside, fewer new sellers and slightly more buyers. There are, of course, a lot more homes on the market now than last year at this time, but 48% fewer homes are for sale right now than in 2019. Like there were 821,000 homes on the single family homes on the market in 2019 at this point. So I expect inventory to fall for one more week before a slight increase as we approach mid-March. Spring inventory is coming. We have not seen a meaningful surge, even as mortgage rates have surged a few weeks ago. So we also haven't seen a dramatic slowdown in buyers enough to reverse this 2023 trend that we've been watching. We continue to have significantly fewer new listings than we did even a year ago. So only 60,000 new single-family homes listed this week, with 14,000 of those going into contract immediately. Last year, there were 73,000, with 24,000 of them going into contract immediately. In this chart, each bar is a week with the total count of new listings. You can see the bars this week are much shorter than last year at this time, 18% fewer new listings. The light portion of the bar are those that went into contract essentially immediately after a listing, went into contract immediately. And this is what I mean when I say there's really no sign of any surge in inventory, even as rates jump back up to 7%. The folks who are the most bearish on the U.S. housing market insist that we will see a big surge of inventory. That hasn't happened yet. When it does, you'll see it here first in this chart. At the right end of the chart, you can see the new listing rate is still very suppressed. Hopefully in the next couple of weeks, we'll see some March inventory help the market. Last March, you can see there were some big spike weeks that kept then climbing towards to peak at the end of June. So hopefully we get a little bit of that seasonal inventory in the next couple of weeks. There are some markets like Austin and Phoenix where inventory climbed dramatically last summer. So in those markets, the current available inventory is around where it was in 2019 pre-pandemic. Most of the country, though, is at pandemic lows with inventory. But interestingly, even in those markets where it climbed last summer, right now, new listing volume is very low. Those markets are not growing in inventory the way they did last year. So if you're latching on to reports, for example, that cite rising inventory as a sign of a market crash, you're probably misinformed. You're looking at old data from last year. There are now 319,000 single-family homes in the contract pending stage. That's a 4% increase from last week, but of course, 21% fewer than last year at this time. 21% fewer sales is a huge difference. This week continues the trend of a normal seasonal climb with enough people buying the limited houses for sale that we see an obvious turnaround from the weak second half of last year, those super weak second half of last year. So that obvious turnaround is still underway. In this chart, each bar is a week with the total count of homes with sales contracts pending. These are the pendings. At the right end of the chart, you can see that steady growth from the really, really low New Year's levels. And this is what we've been reporting each week, right? It's notably different than, for example, November. There were 59,000 newly pending this week. That's the light portion of the bar. We can't see an obvious slowdown of new pendings as mortgage rates pushed higher over the last several weeks. So even though you can measure mortgage purchase applications have taken a dive in that time, it could be that we have such low levels of inventory that even in a time when demand falls, this is still a supply-constrained market. Or maybe it takes a few more weeks, like more time with rates around 7 before the pendings numbers really start to slow down. But they haven't notably slowed down yet, even after several weeks of rates around 7%. We thought maybe we'd seen some sign in last week's numbers of a slowdown, but it's not really there this week. So, we know that with mortgage rates close to 7%, we're not going to see a surge in people rushing to buy. So the sales rates will stay well below last year's pace. And if there's no rush to buy, then those homes that sit on the market may need a price cut. As we've had surprising levels of demand for this new year, the price reductions have been falling quickly. Fewer homes need a price cut. That pace leveled off this week. 31.1% of the homes on the market have taken a price cut. And so you can imagine if a handful of homes watched rates spike and noticed that none of their potential bidders made an offer, then some of those are starting to take their price cut this week. So the price reductions curve has reached its bottom before it starts to climb in March. This year's curve is above recent years, right? More homes with price cuts. And the price reductions are another indicator that the market is significantly less scary than it was late last year, but still significantly slower than we've seen it in recent years. And that's why at Altos Research, we track every home for sale in the country every week. As I mentioned, these videos are national, but we cover every zip code in the U.S. If you need to dive in and investigate your local data, go to altosresearch.com. Your buyers and sellers may have a very different impression of what's actually happening in the market. And we'll help you interpret the crazy market for your clients right now. This is a critical time to keep people properly informed about the market. So hope you join us. More next week.